central banks more or less delivered on the hikes that were priced for this week. The key change that we saw this week was that central banks, in essence, said, unlike in December, market pricing might be right, and that the cuts that are priced in later this year or in 2024, we're not going to dismiss those out of hand. Part of that's been due to the fact that headline inflation, in particular in Europe and the UK, has been decelerating on energy. And in the US, we've seen some improvement in core inflation as well. But our view is that that only goes so far, right? And central banks are more than likely, while they may be pausing here sometime in the first half of the year, are likely to keep rates higher for longer than people think, right? Because of inflation, and if we do ease financial conditions, that's inflationary. We've all seen some of the costs that are going up in some of the services sector. So we think that short duration strategies where these rates are going to stay higher for longer really make sense in fixed income portfolios right now.
Which particular paper should we advise our audience to get involved with?
It's really across the board. So if you think about what quantitative easing did, quantitative easing told you to sell short duration assets and to sell high quality assets, right? Because get out of those. The inverse of QE is buy short duration assets, whether that's high grade, high yield, EM, and to buy quality assets such as mortgages, right? So things like that really fit into a portfolio. And if you think fixed income volatility is going to decrease, which we think it's going to lower but not become low, fixed income volatility, right? We had a 300 basis point move in 10 years last year. We're unlikely to see such a move this year. Some of these options that are in some of these fixed income instruments become less of a cost, so therefore spreads come in and yields return. So it's really that type of dynamic.
There's a bit of a herd going on at the moment, though, isn't there, Robert? And very good morning to you. Everyone's kind of going on the same-ish scenario. Either the Fed blinks or the Fed stays the course. Haven't we all forgotten that inflation took pretty much from 1974 to 1982 to be properly doused? And on Jeff's panel in Davos, we had one of the great students of that, Mr. Summers, basically saying, let's not have to fight this battle twice. Have we all forgotten that this inflation was transitory, then wasn't transitory, and now people are beginning to call it transitory again? A bit complacent?
A little. In particular, you think it's interesting, right? The central banks moved from very hawkish in December to less hawkish today. And what have we had in the interim? We've had China reopening that's gone much greater than anyone expected, right? So we're going to start to see some of the tourism dollars come back globally. And the other part of it is we had a warm weather in Europe, right? The world evolved sort of in the best case scenario from a fundamentals perspective, and yet we're saying the inflation dragon may be slayed. And that's why we think that rates are going to stay, well, again, not, maybe pausing, higher for longer than people think.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.